Good morning, Southeast Missouri, and wherever you may be listening, this is the Retirement Playbook brought to you by Alspaugh Wealth Management. We are the retirement people, and we're here with you every Saturday morning, bringing you some great energy and some great information to help you in your own retirement. And as always, I'm joined by Mr. Tony Shore. Good morning, Tony.
Good morning, Brock Alspaugh. You are a madman. I am so excited. It's Christmas weekend, basically. I mean, tomorrow's Christmas Eve, right?
Holly jolly Christmas.
Yeah, sing it.
You told me. You said don't sing today.
I begged you before the show not to sing. And what do? You never listen,
I'm sorry.
Brock.
I know. I'm like a teenager, like in my house.
Well,
my wife says that she has 3 kids, Gavin, Grant, Brock. So.
Yeah, you're included in that. No, well, it's your show. It's your show. But I think your financial expertise is wanted. Your singing, maybe
not so much. Not so much.
Show.
Okay. All right. Well, listen, I'm really excited about today's show.
Good.
It's who's not in a great mood on a Saturday before Christmas? I mean, come on.
Yeah,
folks.
You gotta be.
Unless you're just Mr. and Mrs. Grinch or something. I don't know. But it's a good time. It's a good time because we've had a great year, right?
Yeah.
Stock market's up, depending on where you're invested, you might be up 20, 30%. You might be up 15 if you're less risky. Whatever. The point is, you're up, okay? And that's a good thing.
It is.
Also, I talked about this early on in the week, Tony, about interest rates. The Feds met last week. They talked about, keeping the rates the same, obviously, for December, but they talked about the potential of having 3 rate decreases next year. And so what has happened since last Wednesday when they announced that is that rates so let's talk about interest rates. When you're borrowing money and you're talking about mortgages and whatnot, that's usually determined by what the 10-year Treasury note is doing, okay? Yep. And so that's kind of the benchmark, the 10-year Treasury. And so that has been over 4% here in the last, 6 months and what have you. But now, this week, it is below 4%. Right. So what does that mean? That means that mortgage rates are now based, on the national average, under 7%. And so 6.83 is kind of the national average. I know that for some people, when you got, a couple of years ago, you were getting 3 and 4%, it seems high. But I want to tell you, folks, 6.83 based on historical interest rates in our country is not bad at all.
No, okay? It's better than 9. It got up to close to 9.
Right.
And so, what we're looking at right now, Brock, right, is the S&P 500 hit a new record high. We've had a year-end rally in the stock market. Interest rates are going down. Inflation has gone down. So the year is ending on a good note for us.
It's exactly why interest rates have gone down. Why did they increase rates? Because inflation was kind of out of control there. Remember, 9% inflation rates. And so, yes, they increased interest rates, and it's working. Okay, inflation is coming down. Now, again, I think we talked about this last week. Maybe they acted a little too late and whatever, but we're not going to go there this week.
Sure.
But anyway, the point is that it's like, it's the holiday season. It's this way all year long. Everybody's should be happy. Okay.
Right.
And so it's a good thing. And Tony, I forgot to mention something. I forgot to mention our website. Okay. I got so excited about today's show. I forgot to tell folks about our website. It's alspaughwealthmanagement.com. Okay. Now, that website is still a little bit under construction, okay? But you can request an appointment with me if you need help in your life with your retirement planning, your investment advice, anything dealing with your wealth, we can help. So give us a call or look us up on the web at Alspaugh Wealth Management, all spelled out, alspaughwealthmanagement.com. So let's just do a little spelling lesson here, Tony, since, Alspaugh's not sure. So it's a little bit harder to understand.
It's a little harder.
Spell.
Alspaugh.
So think of it like this. It's a guy named Al, and he's got a paw, so it's Alspaugh. Okay, and so Alspaugh, of course, wealth management. Sure, you know how to spell that. So alspaughwealthmanagement.com. Or you can give us a good old-fashioned phone call at 573-332-7855 if you need to get a plan and get started today with you and your future. So give us a call at Alspaugh Wealth Management. You can get a lot more information once we go live with that website, Tony. Fully. I think it'd probably be another week or two. So we're getting close. We're getting close.
Very close.
Yep.
Very close. Hopefully before the first of the year, we'll have that new website up and running. But if they go there now, there is a button that says contact. You can just fill out that little form, and someone at your office will get back to them right away, and they can set up that no charge, no obligation consultation, or ask any questions they might have. And then we talk about these things that people want to hear about on the show, and we talk about finances, but we're looking at kind of 2023, ending the year on a good note.
Right.
And then that brings us to looking ahead at 2024. So a lot has happened, and interest rates are huge. And the Fed raised rates to, like you say, combat inflation. There's good things about raising rates, and there's bad things. Some of the good things would probably be like CDs and MYGAs and things like that.
If you're
some
on
of your
the
safer money options, the rates went up.
Exactly. If you're not borrowing money, it's really good, right? I mean, when you can get 5% risk free, why wouldn't you do some of that, right? And also when you're talking about interest rates, Tony, it also affects insurance products. Okay.
Yeah, it does.
And so, for example, let's just talk a little bit about the insurance industry and when it comes to interest rates. When your interest rates go up, and we're talking again, going back to the 10-year Treasury. So we talked about the 10-year Treasury note when we're talking about how it affects mortgage rates. It also affects long-term investing. And so when you're looking at a little bit of a longer term investment, say like in an annuity, okay, interest rates can positively affect or negatively affect interest rates on annuities. And so, for example, right now you can get, roughly, don't hold this to me exactly, but around 4.75% for a 1-year rate inside of an annuity contract. So that'd be a fixed rate at 4.75. But in addition to that, if you look at, like, for example, a fixed indexed annuity where it has a fixed bucket, but then it also has indexing options based on maybe like the S&P 500, it's not uncommon right now to see the maximum return be somewhere in that 10.5% range. So what does that mean, Tony? That means that if the S&P 500 in this example goes up, say 8% in the first year that you own this annuity, you would get credited 8%. Okay. Now, what's nice about the fixed index annuities, and again, this isn't right for everybody. You got to check out your situation and determine suitability and all those kinds of things.
Sure.
But, if the market goes down, you will not go down in value due to the market. Okay. So that is sometimes a very positive investment or an addition to an investment portfolio when you're talking about trying to reduce risk. Also with annuities, you can guarantee income for not only you. What's nice about the IRA, if you have an annuity IRA, individual retirement account owned by one person, but if you have an income guaranteed rider on it, you can actually insure that income for 2 lives, even though it's individually owned, which is something very unique and very positive for a lot of folks out there.
Yeah, they've improved these as retirement vehicles and vehicles to use for retirement income greatly. And a lot of people might be saying, oh, wait, you're talking about annuities, but what about the fees? And fixed index annuities have little to no fees unless you add extra riders. But the annuities themselves most of them don't have fees or have really low fees, right?
That's correct. So, yeah, you're right, Tony. If you have a base contract where there's no income guarantees or a death benefit rider or anything like that, you can add on to it for an additional cost. But the base contract where your principal's guaranteed and you can go up to the maximum based on the S&P 500, that's a really good place for people. If you're telling me I can invest in something that won't lose value based on the market performance, but yet I can get up to 10.5%. And that's a positive thing for a lot of folks.
Yeah. And you don't
Again,
want to put all your eggs in
oh
that
gosh, no,
basket, and it's
no,
not for everybody, but it's guaranteed. And by the claims paying ability of the issuing insurance company, which is a good thing because these are A rated, top rated, AB rated
not every
companies.
company is, but yeah, you want to do
Yeah.
business with an A-rated company for
Yeah.
sure.
Yeah.
And then these are longer term, right? This isn't something you put your money in for 1 or 2 years. I mean, this is typically
Right.
5 years, 7 years.
If it's money you're gonna need to live on this year or next year or buy a new car at
Yeah,
the end of this year, then that's not what you use this
no,
for.
absolutely not. This is a longer term retirement vehicle, right?
Yeah.
And so that's what we use it for. So anyway, interest rates affect a lot of things:
They do.
borrowing money, saving money, insurance industry, the stock market. Okay. If we're talking about interest rates, what do we think about when it comes to say, the effect of interest rates on stocks? And typically what you would see is that your Nasdaq, your technology type companies, especially some of the smaller companies, mid-sized companies, are greatly affected by interest rates.
Yeah.
Why? Because those companies typically have to borrow money to keep the operations of the business going. And so if they have to pay a higher rate of interest, that's less profits and less return for the stock price. So when you're talking about interest rates, it does pretty much affect everything. It affects bonds, right? We talked about insurance industry. What about bonds? Now, what's unique about this year, Tony, is that we have had most of the year an inverted yield curve. So what does that mean? That means that your longer term bonds are actually paying less than your shorter term bonds and bills.
Yeah.
Okay. So, for example, this week, you can still get a 6-month T bill, okay, at say, 5% or maybe a little over 5%. But your 10-year treasury note is only 3.89%. So that's kind of backwards, right? You would think the longer
Right.
you go out, the better rate you would get. And that's called an inverted yield curve. We've had that situation for quite some time now.
Yeah.
Um,
It's
and
been the
and what
same with CDs, right? The exact same.
correct,
Like
correct.
my dad got a small windfall of money when his dad passed. That was my grandfather had in CDs, and he goes, "Well, I'll take that chunk and put it back into a CD." Well, the longer term CDs that he wanted to put it in were not paying anything, and the shorter ones were paying great money, like
Isn't that
5%.
isn't that
But he
crazy?
had the longest he could get and get the top rate was 17 months.
17 months. Okay, see, that's great information,
Yeah.
And so yeah, 17 months is the longest you could go and probably get the same. So the thought was, okay, well, a lot of people, let's just go 5 months and see what happens and that kind of stuff. Well, that's not what to do now. You want to go as long as possible
Right. Right.
because, again, the Fed's already hinted last week that they're going to, if inflation continues to stay where it's at or goes down, they may decrease rates up to 3 times. So if that's the case, then yeah, Tony, that is very smart by your dad, by the way, to say, okay, what's the highest rate I can get going the longest out as possible?
Yeah.
Okay. And so we were doing that with some bond portfolios to say, hey, we want to lock in some of these rates, even
Yeah.
if they're longer term, because we feel like the rates could go down. And so anyway, yeah, the interest rates, man, Tony, they just have an effect on every single
They do.
aspect
Well, they
of.
affect growth, like when companies,
Yep.
even big and small companies and medium-sized ones, if they want to expand and grow, and that's what makes stocks go up is business growth, right?
Right.
If they need to grow, a lot of times they need to borrow money to expand, build more
Right.
manufacturing plants and things. But if there's high interest rates, that's going to stunt that growth. They might wait, or they might not be able to do that. So, like you
Yeah,
say, that
yeah.
affects businesses.
It affects businesses in a big way. And what I would say is that, when you're talking about interest rates and how it affects and borrow, even bigger companies borrow money, although I don't think Apple's borrowing any money with $1 billion
I would
in the bank.
I would assume that companies like Apple, Microsoft,
It's
maybe
kind of
even
like your bank account, Tony. You're
maybe
not
even
borrowing any
Google and
money. You got
Amazon
all the
at
money in the bank. You don't need to borrow money. Yeah, I
yeah,
get it.
on my huge co-host salary. They say radio show co-host doesn't mean anything, so I got the credit troubles. So. Anyway, but seriously, yeah, your Googles,
Yeah.
your Amazons, your Apples, your
Yeah.
Microsofts, they're not worried about borrowing money at this
No,
point.
no, they're not.
But
They're not.
everybody else may need to borrow money.
Yeah.
Plus, even companies with a lot of money might borrow money because they're earning more interest on sometimes huge companies that have a huge cash pile
Right.
are earning a lot of money on that cash in the market, and so they'd rather use the bank's money to expand,
Right.
right?
Yes.
And have it when the interest rates are 3%, it's like,
This conversation, I want to go back to inverted yield curves. Remind me to do that in a second. But this conversation kind of reminds me of, you ever watch Shark Tank?
oh yeah,
Yeah, everybody's seen
love
Shark
it,
Tank. It's a
love
show
it.
on NBC, and I'm assuming it's still playing. I don't know, but Mark
Oh, it
Cuban.
is. They have new episodes and
Oh,
they
do they?
rerun all the
Okay.
old ones on CNBC. Yeah.
Okay. Well, Mark Cuban, I don't know if he's still on there, but he used to be on there. He was the owner of the Dallas Mavericks, and I
Yep,
think he just sold them
he did.
for from crazy amount of money.
Yeah, the
Um,
amount he bought them for and the amount he sold them for is literally like it's unbelievable.
he's
Like
like, well, capital gains rate might change. I better go ahead and get out while I can, So
he made
uh,
hundreds and hundreds of millions of dollars
isn't
on
that
that deal.
crazy? Good for him.
Yeah.
God bless America. Anyway, so he said on the show, he would say, look, if you've got to borrow money to start a business, you're insane. You shouldn't borrow money to start a business. And look, I get it. Like, we're not all Mark Cuban, and we don't have the
Right.
amount of money that he does.
Yeah.
But it is, if you think about it, Tony, it is good advice. It's kind of like me saying to someone, hey, don't borrow money to buy a car. Always pay cash.
Yes.
And if the car that you want is here, maybe we ought to buy a car here,
Yeah.
and so don't buy as expensive one so you can pay cash. It makes sense, right? If you think about starting a business and, I got to have this, and this. Well, maybe you don't. Maybe you just can get by with starting the business at here instead of here if it means you don't
Right.
have to borrow money. So that's some good advice, actually, that he put out. And I have conversations with people when they want to come to me for advice on starting businesses. And I kind of tell them the same thing, like, hey, if that's advice good enough for Mark Cuban, it's good enough for me too. And let's think about it and do it the best way possible. Think outside the box. Maybe there's
Yeah,
some
you
things
have
you
to.
could do to reduce that initial outlay. And anyway, it's just something to remind me of. So let's go back to something I wanted to talk about, though: the inverted yield curve.
Yield curve. A lot of
Yep.
people
So
don't understand that. Yeah.
Yep. So it's basically, remember, your short-term rates are paying higher than long-term rates. That's all it means. Okay.
Yeah.
There's a lot of jargon that we throw out all the time in our world as financial advisors and financial people. And we do a really good job of confusing people. But I try to. And that's
Arbitrage.
yeah,
I like
exactly.
it when the financial advisors say arbitrage.
Hey, wait a minute. I use that word. What are you what are you trying to say, Tony? Anyway, listen. So when that happens, that has historically been a predictive measurement of a recession to come. And
Yep.
so we've had this inverted yield curve for quite some time, and it hasn't happened. We haven't had a recession. Now, if you read some experts, and if you look at some things on, in publications, financial publications, they're saying, hey, we could have a mild recession in the first half of 2024. So if we're kind of moving this conversation along, Tony, to kind of talk a little bit about 2024, nobody knows. Okay. So let me just put that out there. Nobody knows.
Right.
Okay.
Nobody has a crystal ball.
Nobody has a crystal ball.
Right.
And so to say that could happen and you should make some changes. I mean, think about last year, folks. You were down 20 and 30% based on where you were investing if you're invested in the market. And think about what would have happened if you went and got scared and said, oh my gosh, the world's coming to an end. And oh my gosh, I think the market's going to crash. It's already down 15% and 20 now at the end of the year. I'm going to get out. And guess what happened this year? It went right back up to basically about where it was as far as the numbers on the stock market with the Dow Jones and the S&P 500. You have to stay the course, okay? You've got to make sure that you get a plan. Number one, it's kind of like getting a budget. We talk about that B word. Get a budget, stick to it, and update it on an annual basis. It's the same thing with your financial plan. Get a plan, stick to it, and update it when necessary or on an annual basis. And so it's kind of going back to the blocking and tackling here, Tony, the fundamentals of financial planning and retirement planning. When you're looking at your portfolio, just always make sure. And again, this is a great conversation because, last year you might have got a little bit out of balance with your allocation because maybe if you have bonds, they did better than stocks if they lost 20%. And so your allocation becomes a little bit out of whack. This year, same story. Okay. It's been a weird couple of years. Last year, the Dow Jones only lost around 9 or 10%. The NASDAQ 100, all technology, growth companies, lost around 30, 32%. And then middle of the road, it was about up 20 on the S&P 500. And this year, it's completely opposite. The Dow Jones is only up 10 or 12%. The S&P 500 is up around 20%. And the NASDAQ is up around 30%. So my point is it's been weird because there's a big disparity in investment indices. So your value companies, your transport, your companies that are in the Dow 30 have a much different performance in the last couple of years than the growth companies of the NASDAQ. So that's the importance to being diversified as well, Tony. Make sure you're diversified and make sure, because if you try to predict, okay, well, I think, technology companies are going to do great this year, so I'm going to put all my money in that. You might be rewarded one year, folks, but it just overall, it just destroys the fundamental concept of diversification. So just always make sure you're diversified and stick to the plan.
Stick to the plan. Good advice, Brock. Obviously, that's good. And, the Christmas time, this advice is the gift that keeps on giving. This is how we need to head into the new year, is get a plan and stick with it. And a lot of our listeners out there either might not have a plan at all, a financial plan in writing that includes a retirement income plan and a plan for their future and how to cover healthcare needs, Social Security, when to withdraw, when to retire, how much they'll need each month.
A lot of information. Yeah.
To get that in place, how can our listeners get a hold of you? I know you're offering a no-charge consultation.
Yeah, so you can go to our website. It's Alspaugh Wealth Management, ALSPAUGH, wealthmanagement.com, and you can request an appointment with me, okay, and we'll call you and schedule that. Or you can just give us a good old-fashioned phone call, 573-332-7855. Listen, we're going to do a show next week, I believe, right, Tony? So if we're doing a show next week, that is going to be the last show of the year for 2023.
Yep. This might be the last show of the year.
Okay. So if this is the last show, I just want to say a few things. Number one is I am so thankful for all of our listeners. I'm so thankful for all of our, if you're on YouTube, watchers, I'm so thankful for all of our clients, my family, my friends. We love you guys. And this has been so much fun this year. Tony, thank you. I'm thankful for you too, buddy. And I just want to wish everybody a Merry Christmas. And what a year. What a year, Tony.
Thank you, Brock. Great show today. And listeners, that does it for today's episode. Hope you have a Merry Christmas. This episode of Retirement Playbook with our host, Brock Alspaugh, is over, and we'll talk to you next year.